Okay, part B. State your decision regarding the request from the partner and state any further action that would be required to take. So just 2 marks here. Well, are we going to put the expenses through and accept the tennis tickets? No, we are not. Why? Because it is money laundering and a bribe, both bad. Should we report it to someone? Probably, but he is the head honcho. Who are we going to go to? Have to be an outside party. The police, National Crime Agency, or don't specify. Say reasonable third party in your answer. Okay, part C. You have received the following email from one of your colleagues. Hi, I am a new joiner at the partnership and will be working on the partnership end of year financial statements. I've just started my accountancy studies and have only covered sole traders. We have not covered the types of accounts and financial statements used in partnerships. This is all new to me. Please can you help me get started? Kind regards, colleague. So reply to your colleague outlining the accounts and statements used in the partnership arrangement. Your answer should be suitable for someone with no knowledge of partnerships. 7 marks. So our new colleague knows about sole traders, but doesn't know about partnerships. So what are the differences? The main differences live within the capital section. So here we see capital section for a sole trader, opening capital, any capital introduced in the year, profit for the year, less our drawings, closing capital, which should obviously equal the net assets of the business. For a partnership, we have a slight difference. We have a capital account with a balance on it for each partner, and then a total, and then a current account for each partner with a total, and then the combined totals you'll see equal £150,000. Same for the sole trader, which will be the net assets of the business. So in a partnership, the drawings and profits are included within their separate current accounts, while long-term capital invested is recorded in their separate capital accounts. How the profits are split, amongst other things, will be outlined in the partnership agreement. The partnership agreement will also outline how much salary each partner should get, which is not so much salary as it is profit that they are guaranteed to get, no matter how the partnership is performed in that period. Any interest on capital introduced. Any interest on drawings. After all, if one partner keeps taking cash out of the business that could be better invested in stock or assets, shouldn't they pay interest on it? How do we decide which partner should get which bit of profit? We use an appropriation account, which isn't so much as an account as it is a working, because there is never a balance carried forward. We just use it to establish who gets what. Here we see an example. So the profit for appropriation would be the profit per the profit and loss, and then we make additions or deductions according to the partnership agreement. And then whatever's remaining is split based on the percentage of profits they've agreed they get. Now we could get into goodwill, but the question seems to be asking more about different types of account, so it's probably not necessary. So in summary, capital accounts, long-term capital. Current accounts, more short-term, drawings and profit. Each partner has one. Profits for splitting are determined using an appropriation account. The terms of the partnership are outlined in the partnership agreement, which is a legal document. Now, have a go yourself, give yourself 20 minutes, and make sure to prepare it in the style of an email. A reminder of the question is on the next slide. Here's the model example per AAT. Give this a read and see how it compares to your answer. Also, please notice the to colleague at accounts, from you at accounts, and the subject matter. Plus there's a hi, there's no name because we weren't given a name, and regards at the end. So it's at least presented like an email. Thank you for watching this video.